Hello everyone, this is chapter 2, income statement. Alright, first of all, what is an income statement? An income statement is a financial statement that shows the profitability of a company during a period of time, right? This is like a video compared to the balance sheet. The balance sheet was a picture of the financial situation of the company at a specific point in time. The income statement is a video of the financial stage or financial statement of the company during a period of time. Usually it's for a whole year, for a whole quarter, or for a month. Okay, so I'll say it is a financial statement. I like writing things down to make sure that everybody's on the same page. Financial statement that shows the profitability, okay, of a company during a period of time. Okay, usually it's for a year, the year 2017. It's for a quarter, right? You'll see Q1, Q2, Q3, or Q4. Okay, it's for a specific month, for the whole month of January or the month of December. Okay, so the income statement is the financial statement that shows the profitability of a company during a period of time. It could be for a year versus a quarter versus a month. Okay, and what are two main sections of the income statement? Okay, you have your revenues and you have your expenses. Okay, two main sections of the income statement are your revenues and your expenses. And we know that revenues minus expenses, that's the equation of the income statement. Revenues minus expenses will give you your net income, which is also known as the bottom line. So if you hear people in finance speak about the bottom line, they're talking about, first of all, they're referring to the income statement, and they're talking about the net income, right? Net income. This statement is also called the profit and loss statement, right? And profit is your net income, and your loss could be, if your revenues exceeds your expenses, you have a profit. If your revenues are less than your expenses, you have a loss. All right, it's fairly simple. Now let's talk about each of these sections more in depth, so I can make sure that you guys are understanding exactly what I mean by revenues and exactly what I mean by your expenses. I wish there was a way that I could. I wish there was a way I could delete the stuff by pressing one button, as opposed to taking so much time in the video to erase stuff. Okay, so what are your revenues? Revenues is straightforward. Revenues is money coming into the company by selling a product, by selling goods or services. So let's say in your revenues, you'll have a price per unit if you're selling a widget of some sort. Okay, times the number of units sold, right? Let's say that you're selling a widget that is selling for $2 and you sold 50 of them. Therefore, your revenues will be $100. 2 times 50 is $100. Okay, straightforward. Now let's look at your expenses. Expenses is money that you have to pay in order to generate your revenues. Okay, they could be your cost of goods sold, your COGS, your COGS, your operating expenses, any expenses for the normal operation of the business, and anything that doesn't fall into these two categories mentioned will be your non-operating expense. So first of all, you have your cost of goods sold. This is your first expense that will be found on your income statement, cost of goods sold, also known as COGS. The second is your operating expense, also known as OPEX. So if you hear people in finance talking about OPEX, it's simply a operating expense, OPEX. Okay. And the third one is your non-operating expense. Basically, anything that doesn't fall into your cost of goods sold or your operating expense will be on your non-operating expense category. Okay. Let's talk about each of them more in depth. So what is your cost of goods sold? Your cost of goods sold will be any raw material that your purchase or your company purchases in order to make the product that you're selling. Okay, so if you're selling tables, if your company is fabricating tables, therefore purchasing the wood, the nails, the glue, whatever is needed to make a table will be your cost of goods. Okay, the money that you spend to buy the wood, the money you spend to buy the glue, the nails, and the shipping you pay to get these products into your factory will be part of your cost of goods sold. So it's any raw material, including shipping costs, and all of that added together will be your cost of goods sold. Okay. Your operating expense is any cost incurred to operate the business. Any money that you spend to operate the business, any money you spend that is directly related with the normal operation of the business is considered your operating expense. That could be rent, that could be salaries, that could be insurance, that could be communication fees for telephones, for cell phones, internet, whatever it is will be added and will be in your operating expense category or your operating expense line item. And last but not least is your non-operating expense. Basically anything that doesn't fall into your cost of goods sold or your operating expense will be found in your non-operating expense. And two of the easiest examples I can give you right now is interest you pay on any debt that the company has or any taxes paid. Okay, any taxes paid. It's very important that I say paid. Any taxes paid will be in your non-operating expense. Remember to make the difference between accrued tax, right, and taxes paid. So before the tax is paid at the end of the year, you will find that amount on your balance sheet as accrued expenses. Okay, so make sure to understand the difference between tax paid and accrued expenses or the taxes that are accruing before you actually make the payment. So once you pay, the IRS their money, that expense will be found on your income statement. But until you make that payment, that liability it is a liability because it's owed, it's not yet paid. It will be sitting on your balance sheet. So make sure you understand the difference between the two of these, between the nuance between taxes paid and accrued expenses or accrued taxes. Now, these are expenses. So you have your cost of goods sold, which is your raw material and any shipping costs associated with it. You have your non-operating expense, you have your operating expense, which is basically any cost incurred during the normal course of your business. That could be your rent, salaries, insurance, and so forth and so on. And any expenses that is not found in any of these two first expenses will be found on your non-operating expense, and that's interest and taxes and any other expenses that is not directly related to your normal course of business. All right, so now let's look at the structure of an income statement, and it's really straightforward, and it's very easy as compared to a balance sheet. Okay, so you have your revenues at the very top. Okay, you take away your cost of goods sold. Remember, your cost of goods sold is your raw material and shipping cost. Revenues minus your cost of goods sold will give you your gross profit. Okay, very important to understand the structure of an income statement, because if you're in finance, you will have to understand your income statement as well as your balance sheet. Okay, from your gross profit, you take away your operating expense. Okay, once you take away your operating expense, you're left with operating profit. Operating profit. Okay, once you have your operating profit, you back out all your non-operating expenses, your interest and tax, and that will give you your bottom line. That will tell you if your company is profitable or not. And of course, I said if your expenses, right? If your expenses are bigger than the revenues, you will have a loss. Okay, so it's very important that to make sure that you're making enough money to cover all these expenses, and hopefully the goal of any investor, any business owner, any manager, CFO, CEOs, their goal is to make sure that your revenues are higher than your expenses. The least that could happen is that you have your revenues, not the least, but the worst that can happen, or the goal, right, when you project and open a business, is that during your first year of doing business is that your revenues equal your expenses. It's not always the case. As we know, the first couple of years of doing business is quite tough, quite challenging, but the least that you could wish for is that your revenues equals to your expenses, and that way you can conduct business. So that's it about an income statement. Remember, it's a financial statement that shows the profitability of a company during a period of time. It's a financial statement that shows the profitability of a company during a period of time. Could be a year, could be a quarter, could be a month. Two main sections from this financial statement: revenues and expenses. And if you take your revenues, you back out your expenses, you're left with your bottom line, which is also called the net income. Okay. In your expenses, you have three categories. You have your raw material and shipping costs, also known as cost of goods sold, or for short, COGS. If you remove your COGS from your revenues, you have your gross profit. Out of your gross profit, you take out your operating expenditures. You're left with your operating profit. Out of your operating profit, you pay interest and you pay your taxes, and you're left with your net income. And that's it for your income statement.